Welcome. I'm Catherine Magana here with Steve Wolf, Greg Carroll, and Vince Stefano, where we're here to provide you our weekly insights on the markets, planning, and much more. So it's been quite the week. It's still a wild ride. Today is April 17th, and as of yesterday's close, yesterday was April 16th, the Dow Jones for the year was down about 6.76%. The NASDAQ, which is more of tech stocks, was down about 15.5%. The S&P 500 down a little over 10%, and the Russell 2000, which is more of small cap stocks, was down about a little over 16%. So as we're kind of navigating through some of the tariffs and businesses are navigating, trying to figure out what's going on, obviously, some things we have to think about are businesses deferring hiring, how are they spending, and even individual investors, how has anything changed with your lives? And obviously, we're not big advocates of making major changes with your investment strategies during these times, and that's why it's important for us that we have a solid plan in place for you, and we're happy to go over that with you individually. The other thing I wanted to share is sometimes what we look at is the Fed and kind of what some of the indications for rate changes. It looks like based on the CME FedWatch tool that there's a less than 14% chance that the Fed will cut points in May. However, in June, there's 68% odds that they'll do a rate cut, but that's down from last week, which there was an 84% chance. So obviously yesterday, the Fed Chairman Powell came out with some comments, and the market had some more weakness. So that's definitely something that we're watching and monitoring. But at this point, it looks like interest rates have fluctuated a little bit, and on the shorter end of the curve, we're still seeing interest rates with some of like the treasuries and CDs. Right now, the one-year CDs are about 3.95, and the one-year treasury is about 3.99, almost 4%. So we've seen those pull back a little bit over the last few weeks.
Did your article or where you got the info on the Fed, did they say how many Fed cuts might be made this year, did they say?
I haven't seen that. It's just kind of the ones that are coming up, because a lot can change between now and the end of the year, obviously.
Yeah, that's true. I was just curious if they had some outlooks on how many times. But I did notice the bond market stabilized recently after it had some pretty big spikes. I'm not a bond market specialist. I'll defer to other people around the table when it comes to the bond market.
Do you know what a bond is, really?
I really do.
I heard he bought one time.
Yeah, I do know what it is. I've been saying in a lot of these podcasts, I'm trying to remind our listeners not to get too negative and too conservative and get completely out of the market, because what's going to happen is you're going to start seeing things like today. You may see on the news where the Dow drops 400 points and people start to freak out. However, that is one stock in the Dow that had a bad pre-announcement of earnings, and it's causing a negative 700 Dow points to that index.
That's because that stock is down by 23% this morning.
But all I'm saying is
one company.
But
right?
that's one stock. If you look at the rest of the heat map on the Dow, about 90% of the stocks are up or flat. So again, when you start seeing the breathless headlines from the mainstream media and how bad the market is, start to look underneath to see what's happening. Also, there's a lot going on with tariffs. We know that. A number of countries are coming to the White House to negotiate tariff deals. Japan was there yesterday. Italy is there today. I think you're going to start hearing some trade announcements. And again, don't get too conservative. Don't get out of the market. Because remember last week, or was it the week before, when there was an announcement on tariff pauses, the NASDAQ went up 12%. So again, be very, very cautious.
Hey, Vince, I just have one line to say about that. That fear sees a dip, but conviction sees a discount.
Oh, absolutely. And I was, I was going to mention something about that. But I think that when you're looking at your portfolios, again, remember, tariffs are big, but what may even be bigger is the reconciliation tax bill that's in the House. Congress is right now on Easter recess. They'll be coming back next week. I'm sure you'll start hearing tidbits, what's coming out of this bill. We're also in earnings season. I've been saying this for a couple of weeks. Big banks reported last week and actually did fairly decently. Their stocks went up after the earnings report. They guided conservative, but they all said that, hey, things look good. Even credit card losses weren't as bad as they thought. Next week, we have a significant number of large cap S&P companies, or S&P 500 companies are going to be reporting, mostly industrial materials and a lot of consumer discretionary stocks. The following week, we get big tech coming into the market. And I'm starting to see from these analyst reports when they're highlighting some of their stocks that they like, that because of the sizable correction, and a lot of stock prices are down 40, 50, 60% from their recent highs, their earnings multiples have now been compressed. And so instead of being at 30, 40 times earnings, we're now looking at 17 to 20 times earnings, but they're still growing at a significantly high number. So as you mentioned last week, Steve, that's a good positive sign. And to all of my clients, once this earnings season comes to an end, probably end of April after big tech reports, I'm carrying a lot of cash. I'm going to start nibbling on some very good high quality names that I think are going to be great for the next year, 2 years.
Well, I think that kind of goes along with their fear is still out there. Matter of fact, I looked again at our CNN Fear and Greed Index, and it's currently at 19. So what does that mean?
Is that up from last week?
Yeah, it actually was at 4 2 weeks ago, 6 last week, and now it's at 19. And 25 is where you get out of extreme fear into just regular fear. Not really sure what that means, but that's 25 to 45, and then 45 to 55 is neutral. So we're still a long way from neutral. There's still a lot of fear out there. But, to me, if you need antacids, every time you turn on the news and the market dips, you don't have an investment strategy. All you have is indigestion. So a little quick story here about tariffs, tweets, and Tums. So there's this guy, we'll just call him Dave. Dave wakes up, he checks his portfolio, checks the news, and immediately needs a Tums. He says, Trump just tweeted tariffs on everything in all caps. Boom, Dave sells half his portfolio, and now he's in cash like it was Y2K all over again. 2 days later, another tweet. China's our friend, tremendous progress. Markets will love this. The market bounces back. Dave misses it. Now he's got cash, regret, and heartburn. Meanwhile, his buddy Rick, he's not even phased. Rick's over there grilling salmon, maxing out his 401k, and treating the Trump tweets like background noise on a Southwest flight. Because Rick knows tariffs come and go, but bad investing decisions, those stick around. So the key to all of this is you don't want to panic. Here's something from Guggenheim. I know we talk about this all the time, but I still hear a lot of fear in people, a lot of fear. And I'm not saying, that's not normal. I mean, things are headed in a direction that we haven't seen before, so change causes people to be scared. But this is from Guggenheim. Pullbacks are often not a time to panic and should rather be used as a reason to analyze and assess. Under certain circumstances, it may even be the case that a pullback represents an attractive buying opportunity for certain portfolios, which, Vince, that's what you're saying. The benefit of gaining reliable market and economic perspective is essential in preparing for market pullbacks. Rather than act on emotion, it's important to put these events in context to determine what they mean. Okay, and that's really, really important. There are a lot of good things that are actually happening because of this whole threat of tariffs and wanting to have companies come back to the U.S. Just recently, NVIDIA is one of the companies that says that they're going to put $500 billion into a manufacturing plants in Arizona and Texas. Some other companies that are saying they're going to invest here. Eli Lilly, nearly $50 billion. ABB, $120 million. Discovery Group, shifting manufacturing from the UK to the US. Hyundai, $7.6 billion. Stellantis and Samsung, $7.54 billion commitment from the U.S. government. for Kokomo, Indiana. So this goes on and on. Intel, $20 billion. Samsung, $17 billion. Micron Technology, $20 billion. So it's not a reason to buy or sell any of these stocks. What I'm telling you, though, is that one of the things that Trump wants, and I would think most people would want this, is for there to be more manufacturing here in the United States. We've lost a ton of jobs to other places. Now, I don't think we're going to be manufacturing, T-shirts and gym shoes, or sneakers. That's not going to happen. But anything I think that's important to our defense, you kind of want to have here. I mean, if we are in a war with China, heaven forbid, but if we are in a war with them, we don't want them controlling all of the things that we need for our defense. So as much as this is causing consternation, and it is, sometimes you got to wonder, has this really been well planned out? Not so sure. But the idea here is that not only do we want tariffs to, I shouldn't say this, I think the idea is we want tariffs to come down, and we want some of the barriers to our products to come down. But we also want manufacturing here, and that's jobs. That's jobs for our country. It's good for our country.
Yeah, I would agree with that 100%. I like you mentioned, Steve, is maybe the way that the administration is going about some of these might not seem very well thought out, and I think that's what gives people consternation. Uncertainty, the fear, needing the Tums, because if you do pay attention to the tweets too much, you can get a little upset. But if you ignored that and look, even for the last 2 weeks, what has really happened? Things go up and down, but we're still about where we were a couple weeks ago when, what was it, Liberation Day, or what they call it?
April 2nd.
So I thought I would channel my inner Rachel today, since she's not here, and talk a little bit about taxes.
Oh my God! I thought we'd have a week off.
I just paid.
Well, that's why. See, everyone's talking about tariffs, and staying in the market, stay the course, all this. Let's say, let's take advantage of this time. We can, you probably have done at least most of your taxes, whether you finished them or not, or had an extension. But you might have a good idea about what your portfolio is doing for you as far as tax-wise. Where is all your dividends and interest coming from? Is it in your IRAs? Is it in your taxable accounts? You want to look at tax positioning, where you can really save a lot of money in the long run if they're positioned better. Your IRAs are always taxed at income tax rates. That's income coming out. So if you have too much growthy type investments in there, maybe look at putting those out in a taxable account where you can get long-term capital gains tax rates. You reduce your taxes. I think this is a good time to do that. Looking longer term, work with your financial advisor, work with your CPA, but there's opportunities out there, and
it could be a time to look if you have a lot of gains. Let's say you sold some of the things that you did really well with over the last 2 years, and now you've got some losses somewhere. You may want to take some losses to offset those gains. Yeah,
you might. Maybe you were way overloaded with tech. It's time to rebalance, but you got to look at that from a tax standpoint. So this is a good time to do it. It's top of mind. You have all your records. It's probably a good time to review that.
Yeah, and usually too, you talk about having all tech. Over the last 2 years, if you had tech, you did really, really well. But it's doubtful that the same group of companies will lead the way out of into the next market. It's not that they won't do well; they probably will, but they probably won't lead. So it's a good time to assess. Take a look. Where are we? If you have things other than stocks in the portfolio, they've probably served as a nice balance. And that goes back to what Catherine says almost every week, because she's
a reminder.
Yes. Right. That it's good to be diversified, especially if you're older and you don't have 50 years to go until your demise. It's good to do that. And as you get older, make sure you have enough income, and it could come from a lot of different income sources. But those are the things that offset these temporary, and I think they're always temporary, dips in the market.
Well, it's interesting you say this, Steve, because I actually saw a client this morning, and she said, I'm not nervous. I haven't called. And she listens to our weekly podcast, and she knows, we have a plan in place. We know exactly what we're doing, what income she's getting. And so we're not trying to navigate this and make changes when this market's really volatile. So it's interesting because not everybody is scared when we talk about being nervous in the markets, but also there's clients that have weathered and seen these types of things and feel good about where we're at, and we're here to navigate that with you. The other thing I wanted to share is a couple of weeks ago we talked about Social Security and having to go into the office. And that has now flipped. So the Social Security Administration now has said they're back on using phone service. So those individuals can now call on the phone or telephone. They said they have some new anti-fraud things in place for when clients call in. So, but in reading the article, it looks like there were already some things in place, but they're enhancing that. So there's now an about face of, a little change back. So I don't know how quickly, it seemed like that came in pretty quick, but we just wanted to comment and note that if for Social Security, it sounds like you can call in again.
And what they were saying, or what we heard, that you couldn't call before.
That they switched it from being able to call in, that you needed to go into the office, is what that, so to set up an appointment and go into the Social Security office.
Oh, that you had to go to their office.
Correct,
Okay.
but now it's back to the kind of old way of you can call in again, but they have some different security
Well, I think
measures.
one of the things that they're certainly talking about is modernizing our entire government's technology.
Yeah.
Because we're so backward with what we have, and computers
Just
don't talk.
ancient.
We really are.
Ancient.
Computers don't talk to one another, and we're not using all of the modern technology that businesses use.
Right.
And you can streamline the government just as well as you can streamline a business, and it will cost less, and that obviously will help us in our fight for a balanced budget and getting rid of our debt.
And just think how much technology the government will start buying. And some of those wonderful technology stocks are going to do awfully well. And just remember, I keep saying it, technology is 21% or 22% of the S&P 500. But within technology, you've got multiple subsets. You've got the chip stocks, you've got cybersecurity, you've got software, you've got financial technology names. So as you go through your report, and as you even start looking into the future, and you had said that a different type of technology stock may lead, I agree with that. But I also am going to say that probably the top 15 or 20 tech companies in America will continue to be the best innovators. And what will probably happen as this market goes forward and some stocks remain relatively cheap, you'll start seeing more M&A activity where the big boys are going to start buying the smaller ones because it's always easier to buy than build. So a lot of the stocks that you think that may lead could be the ones that, get acquired in a couple of years because, their valuations are looking very, very good right now.
Yeah, I'm not saying technology won't do well, but for instance, the chip stocks did unbelievably well.
Yeah.
It's hard for me to believe that they'll do the same. It doesn't mean that they won't go up.
Right,
They
right,
probably
right.
will.
I agree
who
with
knows?
that. Right. I do agree with that, and I think that you've got a number of chip names that they continue to innovate, more and more and more. So
Right. But history teaches us that usually the group that led in one bull market usually doesn't lead in the next bull market. So you got to look for those, maybe the subsectors of tech or wherever. I don't know, energy, nuclear. Who knows?
Yeah, we've been talking about that for a while too.
Right.
But again, I don't see food stock cement companies as being the big leaders and the breakout stocks of the S&P 500. So.
Well, I don't think Procter and Gamble or Kimberly Clark is going to lead or something like that. Although they're good companies, they pay good dividends.
Right. They just don't lead.
But they won't lead.
It's hard to innovate in food and
That's what I'm saying. That's
make
why-
a new bowl of Cheerios or
That's why I'm gonna keep focusing on a lot of technology over the next 2 years. I
Right,
think
but-
we're still in such a tech revolution that it's and medical technology. You've mentioned it a lot,
Right.
and I agree with you there. Medical technology is going to be huge over the next 3 to 5 years.
I think you're right, but again, we don't know. I guess it's always possible that the Kimberleys and the Procter and Gambles and the consumer staples could lead, and they might lead in a really bad year because those are safer companies. So we're not saying buy or not buy those, but my gut instinct tells me that the big growth is going to come from somewhere in technology. It just probably won't come from the same place. that has been leading the charge over the last couple of years. And again, I think those, you look at some of the technology companies from 30 years ago. They've done extremely well, but on a percentage basis, they're not doing better than some of the newer technology companies over the last 5 or 10 years. Okay, it's just a matter of growth. I mean, you get to a point with any company, and you can't turn around a battleship as quickly as you can a rowboat.
Tyranny of large numbers.
Which means
The bigger you are, the tougher it is to keep the growth going.
the growth rate.
Yeah, the growth rate going.
Right, and that's all I'm saying.
Yeah, you don't grow at 60%, you grow at 30. But 30 on $40
20
billion
or 15 or 10 or
on
whatever
40,
it is.
$50 billion is a huge number.
It's a huge number.
yeah.
It is. I agree.
And there's always new companies being spun off, or individuals that work at these big companies that have grown so well, and they might have a better idea.
Right.
Start out in the private markets, and then pretty soon, they're disrupting.
Right. Well,
one
and I think
industry or
that'll happen
another.
because of all the chips that are now out there
Sure.
that are creating new opportunities. So if you're really looking for ultra growth and you want to take some risk, which there's nothing wrong with taking some risk with part of your portfolio, you're probably going to look for those companies that are being advantaged because the chipset that they have is so much better than they were just a couple years ago.
Mm-hmm.
So, all right. Well, the market continues. I actually think that the fear has calmed down a little bit. It's still out there. The volatility certainly has calmed down a little bit. We're still volatile, but not to the point where we were 2 weeks ago. That volatility index, I think you said hit close to 50.
That was last week.
That was a fix last week. Yeah.
Right.
Yeah.
And this week it's down in the 30s. It was in the teens. So we're still up there, but not nearly where we were. And, who knows? Maybe peak fear has hit. Hopefully peak or not peak, but the lowest level of the market has hit the bottom.
I was just going to say that, I think we've made the lows in the market.
We'll see.
I
Hopefully.
think we have. And you know what? Tomorrow, market's closed, so don't take any Tums tonight.
There you go.
All right. Well, thanks again for listening to us this week. We'll be back next week with another exciting WWM Talks.
Thank you.
Bye-bye.
Thank you.
Bye.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.